Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is an energy specialist, a keynote speaker in the oil and energy industry. He's routinely the keynote speaker at these major conferences. He was also a petroleum geologist for over 17 years. Art Berman, thank you for joining me again.
Pleasure, Jason. Nice to be here.
Now, Art, the oil price, we're recording this today on Thursday, May 24th, 2018. We got WTI crude a little bit above $70 a barrel, Brent crude a little bit below $79 a barrel. Are we at an oil price now where marginal high-cost oil production like Deepwater, offshore oil production that has not been online in years will be economic and start to come back online quickly, in your opinion?
Well, the simple answer is yes, it should be economic at these prices. Whether it comes on quickly is another story altogether, and that's because the offshore, particularly the Deepwater, involves a much longer term kind of view. And so, for instance, with the onshore wells and the shale plays, price can be economic, and you drill a well, and 2 months later you're producing. You don't have these long lead times. You don't have the kind of giant investment that it takes to develop offshore fields, which is billions of dollars and takes several years. So the answer is that, yeah, the price we've got right now is clearly commercial for at least the better offshore prospects, but the companies have to have some confidence that the prices are going to last, because the timeline of their investment is many years. So they make the commitment now, and by the time they get the platforms built and the pipelines put in, maybe prices are now sub-commercial. So it's a riskier kind of a proposition, because you don't know where prices are going.
So you're saying then that the wells that were capped, that were economic at one point, those Deepwater offshore wells that potentially could produce 50,000 barrels per day or more, these are large wells that could bring on a lot of supply, that the oil companies would have to be confident that the oil price is going to maybe stay at these levels for 6 months or 12 months or longer then before they would start to uncap those wells and start to bring them back online?
Well, okay, so let me clarify something. Those wells were, when you say capped, it's not like they were just shut in. These are, when an exploratory well is drilled offshore, it's called a disposable well. Okay, so they're drilling the well to, first to discover the field, and then they'll go drill another well or two to confirm the discovery and establish a water contact, whatever they need to do so they can book the reserves. But those wells were drilled as test wells only. They were never drilled or designed to produce oil. Okay, so that's why we call them disposable. And it's, it sounds incredible because they're really expensive wells, but that's the way the offshore works. The first couple of wells you drilled are simply to make the discovery and to confirm the discovery, maybe appraise the discovery a little bit, and then you're done. And then you decide to sanction the big investment in which you go in and drill development wells, which are designed completely differently. They're drilled from a permanent platform or a semi-permanent platform. That in itself is going to cost you, many hundreds of millions or billions of dollars. So nothing's capped. Once you make the investment in a development well offshore, if the price of oil goes to $10 a barrel, you're going to keep producing it because of the long-term nature and the high level of the investment that you made. So I think that's important to clarify. They don't cap wells in the offshore. Once they decide to go, they're going all the way.
That's very interesting because, I've been monitoring what Transocean and Diamond Offshore and some of the other players in that industry, and they've had, a lot of CapEx cuts, a lot of spending cuts for years now. So So basically then a lot of those wells were running when the oil price last year, when the oil price was down at $45 a barrel. You're saying that those wells were still running at a loss, the ones if they were development wells?
Sure. Oh yeah. Well, yeah. I mean there are certainly some wells that were reaching the end of their commercial life anyway. I mean, these offshore wells, the attraction, the economic attraction is that they have very high rates initially, and typically they don't last 20 years or 30 years or whatever like an onshore conventional reservoir. That they're pretty much I don't want to overgeneralize, but 7 to 10 years, and that's pretty much the productive life of the well. So it's certainly reasonable that wells that were reaching the end of their commercially productive life, those wells might have been abandoned, plugged. I don't think they were planning on re-entering and producing them again at higher prices. I just don't think that works. So that's my understanding of the offshore, Jason. It's a very, very different world for sure. But having said that, and having made these comments, to think that only the onshore shale plays are reducing cost is to miss the point. These same kinds of economies of scale and deflation of oil field service prices, it's going on everywhere. So the cost of drilling and completing a well, no matter where you want to talk about it, is substantially lower. I'll say just, as a round number, 40% lower than it was in 2014. And that's before you ever make any improvement in your technology or in your, the way you optimize the efficiency of the operation. So, it's not as if the big companies that operate in the offshore have been asleep for the last 3.5 or 4 years. They've been working on plans to figure out how to cut their costs too. So I read a really interesting report very recently by Goldman Sachs, which in fact predicted that the offshore will be more commercial than the shale plays going forward because of the fragmentation of the onshore business. There's just so many thousands of little operators. There's just not the same kind of opportunity for the economies of scale, which the much more limited number of operators in the offshore provide. In fact, Goldman even goes so far as to say that it won't be that long before shale wells could perhaps be the marginal barrel. And I don't know if I go all the way in endorsing that point, but that is a point that they made pretty strongly.
So would you say then that it's more likely still that at the current oil prices we have now when we're recording this, that the U.S. shale oils plays in the Permian, the Bakken? I know you recently put out an article that the Bakken oil production has started massively increasing again because of the higher oil price, that will be where the oil production growth globally will be still? Or do you think that more of the marginal oil production that's going to come online in the near future, if prices do stay at these levels or go higher, is going to be from Deepwater then?
Okay, well, a couple of clarifications. I don't think I ever said that the Bakken was growing strongly again. I did a report about a year ago in which I suggested quite the contrary, that the Bakken reservoirs were running out of energy, and that was my interpretation. But the reality is that the last 4 or 5 months of production up there have all been declining. So I think November was about as high as the Bakken got in its recovery back to December 2014 peak levels. And in the reporting months we've got, December, January, February, March, maybe April, it's declined in all those months. And that's significant because we're still 5% below those December 2014 production levels, and yet we got 4,000 more producing wells today, a quarter more than they did now. So the point is that you're doing less with more. So
Oh,
my view of the Bakken is, I can't say they could drill a bunch of uneconomic wells and accelerate the rates, but not necessarily make money on those. Well, they might be able to get it back up to peak or even a little bit higher. But I think Bakken growth is done. Now, don't get me wrong. I'm not saying Bakken is over. I mean, there's a long tail, a long decline to the production. I mean, these are you got 12 or 13 or 15,000 wells out there. I mean, you're not just going to stop producing. So
yeah,
Eagle Ford,
it can
sorry.
plateau, right? The production can plateau, and it could be pretty consistent for a while. You're saying then, right?
No, it won't plateau. It'll peak and decline. I'm saying that the decline tail will be long. So the Bakken will continue to produce for maybe 15 years after it peaks. But I don't think it'll ever come back to the levels it was. Now, the Eagle Ford Shale in Texas, I just recently did a report, gave a talk or two on that, and I think it's for different reasons. I think it's in the same place. It's 1 million barrels a day below what it was in 2014, early 2015, and I don't think it's coming back. I think it's been over drilled. And if not over drilled, it's been drilled as much as it can optimally. And so I see declining production, maybe slowly declining, but declining production for the Eagle Ford. So growth is over in my book for the Bakken and the Eagle Ford, two of the really big engines of the shale play. So that pretty much leaves us with the Permian. Permian growth is not over. I was grossly misquoted by a couple of different journals when I gave this talk a few weeks ago at the Texas Energy Council in Dallas, but that's fine. But the problem with the Permian, I know, is that there's simply not enough pipeline capacity, not enough frac crews, not enough sand for the fracking. They're operationally constrained in the Permian. They can drill all the wells they want, and they are drilling a lot of wells, but the amount of the discovered oil that can be converted into supply will be limited until more pipelines get into that area. And the forecast, the optimistic forecast, is sometime in the second half of 2019. And I think a more realistic forecast, not mine, of course, but industry forecasts, are probably not until the first part of 2020. So for a year and a half and a little bit, very difficult, I think, to grow supply in the Permian. And I think that the forward curves reflect that. And I can promise you that the differentials, in other words, the price that at the wellhead that an operator is getting today in the Permian versus what he might get, say, in east, in the Eagle Ford, it's as much as $10 a barrel less. Why? Because there's not enough capacity to take the oil away. So it's a buyer's market. The pipeline company, you go to a pipeline company and say, I'd like you to take some of my oil, and the pipeline company says, sure, we'd be glad to, and we'll give you $10 less or $7 less than the going rate for WTI. And the operator said, well, that's not fair. I don't want to do it. And the pipeline says, take it or leave it. You want to monetize your investment or not? If you don't want to, there's lots of guys standing in the line who will. It's the way it always works. So what I'm saying, Jason, is that the Permian, for as good as you might believe it is, and some do, and others are more skeptical, there are just physical constraints to adding supply in the Permian. And I think almost everybody in the industry even optimists would agree with that. Public doesn't really get that, though. They think it's Saudi Arabia, and whether you think it is or not, it's Saudi Arabia that can't add much supply.
And the Permian
for now.
And the Permian production at some point in the future is going to peak anyways, despite it's going to be like the Bakken as well, that despite the more and more wells that are drilled, you're going to get less energy return on energy invested. The wells are going to decline. So at some point it's going to peak. I'm not going to tell you when. You know, the thing about, I don't want to have a long discussion about peak oil, but I think the mistake a lot of people make is that they think that we're going to run out of oil. We're not going to run out of oil. It's a function of price. But all the wells, all the major oil fields, all the major wells eventually do peak in terms of their production, though. So you talked about the Bakken. Thanks for the qualification. I think the reason I got it wrong was because on last week's Macro Voices podcast, Eric Townsend was talking about the production increases, but he didn't say that we were getting in the Bakken less for more, that we were having to drill more wells and they weren't productive.
Right.
So Sorry, go ahead.
And I listened to your interview with Eric, and it was excellent. I mean, he's really a first-rate guy, and he's interviewed me many times. So, I encourage the folks that listen to your podcast, if they haven't heard what Eric had to say, should listen to it, because he's a very smart guy, and he explains things clearly, I think, too.
So Eric thinks, he mentioned in that interview, since you listened to it, that he thinks that the U.S.'s oil production is going to increase because of the Permian, up to 4 million barrels per day. Do you think that's realistic, that that's going to happen in the near future, or do you disagree with him about that?
Oh, these forecasts are they're highly speculative. So I just explained to you the main reason that I think that Permian production can't grow, whatever the right number is, 4 million, 3.5 million. I mean, and also you have to qualify, is it all Permian production, or are you just talking about the tight oil, the horizontally drilled, hydraulically fractured? I don't want to get into the details of that, but no, I think that in the near term, which is to say the next 12 to 18 months, I think that additional production will be limited. That doesn't mean it won't grow. It just means that, these blue sky kinds of forecasts cannot happen until the infrastructure catches up with the potential productivity. But what I do want to say, Jason, is that, I have looked at the Department of Energy, EIA Energy Information Administration's production forecast for all three of those plays, Bakken, Eagle Ford, and Permian. And I got to say that they are absolutely, pie in the sky kind of thing. They're, what I did was I took the proved reserves that the EIA agrees with in all three of those plays, and I took their production forecast and just started summing up. Well, okay, you say it's going to be X number of million barrels this year and next year. And what I found was that if you use their forecast, all three of those plays completely exhaust proved reserves by the early 2020s. And yet the forecast has them just, merrily increasing and increasing all the way out into the 2040s. So where's that oil coming from? It's oil that that hasn't been proved as a reserve yet. And in fact, in the Permian, I did a calculation. Actually a compilation. I took all of the annual reports for the companies that operate there, and they have to state in these reports what their proved reserves are, and they have to be certified by a company. And I said, okay, let me add all those up, and those companies I looked at, there were about 15 or 20 of them, they constituted a little more than half the Permian production. So I simply, scaled the value, divided their number by 0.48 or 0.5 or whatever, and I came up with a proved reserve number, which includes undeveloped, of about 6 billion barrels. Okay, which is, it's a lot of oil. That's great, but at current production rates, if production never increases, we will exhaust that 6 billion barrels that's left in 7 years.
Wow.
So, that's kind of a sobering thought. I mean, it doesn't mean that that's the end, because presumably they'll find more reserves between now and then. But for those who think that somehow the Permian Basin is going to support the world's supply needs for decades, I think you need to think again.
Yep.
And it's I'm in no way criticizing the EIA, because I have a lot of respect for them, and I'm certainly very dependent on the reliability of their data. But their forecast in this case, I think, is wildly optimistic.
And they tend to extrapolate trends, right? So if a trend is one way or another, they tend to just draw like an extrapolation trend line, a linear line, right? So I remember.
No, I think they have fairly sophisticated modeling. But the problem is, as I see it, the people who do that work, they're not industry people. They don't. It's an unconstrained model. Let's put it that way. It's not dependent on price. And I called them on it. I said, where are you getting all these numbers, all this oil beyond proved reserves? And the answer I got back was, oh, well, those are technically recoverable resources. Well, what's technically recoverable resources? Well, for one thing, it's undiscovered. Okay. I mean, by definition, it hasn't been found yet. So, some of your audience are going to roll their eyes back right now and say, wait a minute. But more importantly, or as importantly, I guess, a technically recoverable resource simply says that with the technology that exists today, that's the amount of oil that can be brought to the surface and extracted without any consideration of the economics of that project. So, that oil could, the cost of producing it could be $500 a barrel, and it still fits in the technically recoverable resource category. So
it's
that's
not realistic.
Well, it's unconstrained is a polite way to put it. Okay.
Well, most people can't afford.
And that's in that scenario. Let me just finish. Is just as true for EIA's forecast for the Bakken and the Eagle Ford. So there's this huge, larger than existing reserve, like maybe 3 times or 2 times bigger in every one of those plays than what we know is there today. And that's what's going to carry U.S. production, and that's what's going to supply the world. So, I think that people who really want to understand the truth of supply need to look at that. And, I've got those charts. They're publicly available on my website, artberman.com. Anybody can download them. Tell me if you think I did something wrong. They've been out there for, a month. And so far, there are a lot of people that say they don't like the feeling they get from them, but they're not saying they're wrong. So, check it out for yourself, because it's just straight, it's just addition. You don't have to be a petroleum geologist to add the production from one year that EIA says to the next and the next and the next, and say, okay, ding, we got to 6 billion barrels. Now what? So that's my view.
I think you're more kind to the EIA and the IEA and the other agency than Dr. Chris Martenson. I know you've spoken with him a number of times in the past, because he called it basically at one point like a wedge of hope, where they made an enormous assumption that 10 different gawars were going to be discovered. I remember seeing that in one of his presentations a couple years ago, that they just assumed that the oil reserves would pretty easily be replaced. So, but I want to ask you, though, about the balance sheets of a lot of these shale oil producers. So basically, my view of it, when I look at the financial statements, I don't see a lot of free cash flow generation, but it seems that a lot of these shale producers, they've had a lot of debt expansion, but I guess that's okay temporarily for them if they can expand their revolving credit facility, as long as they're hedging. So from your experience, looking at these companies, talking with people who run these companies, do you find that the people who are financing these shale oil production companies are requiring, in exchange for the credit expansion of revolving credit facilities, the expansion of the debt, that the oil producers hedge a lot more of their oil production than in the past?
Well, it's a good question, and the answer is, unfortunately, it depends. So, in other words, if this is what we call reserve-based lending, in other words, if this is, a bank is lending money based on yet to be produced reserves, there's not a heck of a lot of that going on these days. Okay, That was exhausted many years ago. So if we look at what are the preferred means of financing in the E&P space today and have been for some time, they've of course been private equity, which is going to carry a much bigger burden of interest rate and other kinds of restrictive clauses. And then there's just simply, dilution of shareholders. Huge amount of the capital that's been raised since the oil price collapse has simply been secondary offerings of stock that have been gobbled up, billions of dollars worth, sometimes in a couple of hours for the right company and the right play, namely the Permian Basin. Now, those kinds of mechanisms for raising capital don't have any strings attached whatsoever. So, I can't tell you what sorts of requirements or covenants, if you will, the private equity capital puts on the company. Again, depending on whether it's actually a loan. And then, of course, there are bonds. I mean, there's corporate bonds, so-called high yield or otherwise known as junk bonds. I think those are, coming back into favor. They were out of favor for a while, but I mean, that was a big mechanism for raising capital during the high price years of 2011, 12, 13, 14. So, you're right, Jason, but I think the notion that these companies just, they just borrow money from a bank. I'd be shocked if that amount of if their debt is, if that is even 50% of their debt these days. So, but you're right. Hedging, regardless of the reason for the hedging, is an important consideration. And right now, of course, companies that thought they were really smart by laying in hedges, back when oil was $45 a barrel, not so long ago, at 50 or 51 or 52, now they're losing their shirts on those deals. I mean, there's some financial analysts have estimated that the lost revenue from basically underwater hedges is going to be extremely significant on the balance sheets in 2018. And the exact same, the same was true when oil prices went up last time, 2009, 2010, whether it be for oil or gas, that companies lost a lot of money because they'd locked in hedges at too low a price. So today, I mean, what we see, and Eric talked about this to some extent, what we're seeing is that the tail of the forward curves is now starting to move up. The degree of backwardation, the steepness of that forward curve has been declining now for several weeks, and I think will continue to do that. And Eric expressed a certain amount of bafflement as to exactly what's going on there, but that is what it is. I mean, that's what's going on. And so what we're seeing is, the front month prices are going higher, and yet the long dated contracts are also going higher at the same time. And so we're kind of in a weird place right now that not many people understand. I certainly, I can speculate on it, but I don't think there is a clear answer yet. We'll probably understand it better going forward.
Yeah, I'm not an expert at that, but I do know if interest rates do rise, then I think they will probably negatively affect shale oil companies that issue junk bonds, high yield.
No doubt. Higher interest rates will absolutely change everything, because the entire shale oil and tight gas booms of the last 7, 8, 10 years have mostly been based on close to zero interest rates. So free money, or at least very cheap money, other people's money, has allowed a certain kind of capital flow into these companies that even little 0.25% increases, maybe once, 2, 3, 4 times a year, it means you gotta pay a lot more for your debt, and that that will have a profound change cumulatively over time.
And you called shale oil a retirement party for the oil market and not a major technological breakthrough. So I think, like you said, the interest rates definitely fueled the shale boom more so than just the technological breakthroughs that did happen to occur.
Yeah, I mean, I don't want to be pessimistic or anything, but I think what you have to ask yourself, forget about being someone who lives in the oil business as I do and have for 4 decades now. I mean, just for ordinary people who are interested in investment or just interested in the lifeblood of the economy. For all of if you filter through all the chest beating and the sort of quasi patriotic statements about technology and how unique and exceptional Americans are, the undeniable fact is that a barrel of oil today, even at the low prices that we've had for several years, is still like 30% higher in constant dollars than it was in 2004. So, not even 15 years ago. And I'm not doing any kind of, financial sleight of hand. I'm just saying, what was the price of a barrel of oil in 2004? And let's just use, an inflator, standard, you can get it off the Federal Reserve website. What is, let's just say it was $40, $35 a barrel in 2004. What is that in 2018 dollars? And what you find is that it's more now than it was then. And so all of this technology and all the great, wonderful things we hear, the net result is that oil costs a lot more now than it did 15 years ago. And you can draw whatever conclusions you want about that. But the conclusion I draw is that, the world runs on oil, like it or not. It runs on a lot of things, other energy forms, but oil's the main thing. And as long as we're dependent on oil and its refined products for, gasoline, jet fuel, bunker fuel for ships, et cetera, the price of oil affects the cost of doing business for every single one of us. Even if we're not in the energy industry, we got transportation costs, we got manufacturing costs. And if oil is, for round numbers, 30% higher today than it was 10 years ago, why are people so surprised that we're having a hard time growing the economy? Well, I'm in business, you're in business, most of the people who listen to this are in business. If your cost of doing business goes up by 30%, I don't care how good you are, you're going to have a hard time making the same amount of profit that you did 10 years ago. It's not that hard to figure out. That's the problem. That's the problem that the world has. And if you've got a lot of debt on top of it, well, you compounded your problem because now you got to give away more of your whatever cash or whatever margin you make. You got to give it away to the bank or the private equity guys or whoever it is because you got to service your debt. So that's an undeniable fact.
Exactly, and the energy return on energy invested for the oil production we do have, it gets worse every decade. So if you went back 4 or 5 decades, the energy return on energy invested we were getting 4 or 5 decades ago was a lot better than what we're getting now, just like it was a lot better 100 years ago when the U.S. was one of the main oil producers in the world. Although, now the U.S. is back, but I think that shale is probably temporary. I don't think in another decade that the U.S. is going to be the major oil producer per se.
Well, let's talk about that for just a second. There's a tremendous misperception that's going on here about how the U.S. is the biggest producer in the world, because we're not. Again, you can use sleight of hand, statistical sleight of hand to make it seem so. But the way that people come up with that answer is they look at the amount of oil we produce and the amount of refined products that we export. And when you add all that together, you come up with a big number. The problem is that a giant portion of the refined products we export are made out of other people's oil. You know, we import oil from somewhere else. We bring it into our refineries. We create gasoline and diesel and, you know, various other products, and then we send it back out to the rest of the world. And so as my colleague Michael Levy said a couple of years ago, you know, if a country doesn't make any cars, but imports cars from, say, Italy, you know, millions of cars, brings them into their country, paints them green, and then exports them back again, is that country now a major exporter of cars, or is that a country that paints cars green? You know, I mean, that's what we're really talking about. So the United States, I mean, we are importing today, this week, last week, between 7.5 and 8 million barrels of crude oil a day. Okay, that number hasn't gone. It's gone up, actually. It hasn't gone down. Now, if you do the net calculation, like how many barrels we import and subtract from it the amount of barrels we export, that number has gone down, but it's still, you know, 5 to 6 million barrels a day. So this you know, this idea that we're somehow going to be oil independent or going to be a net exporter of oil, I mean, you know, again, don't take my word for it. You know, get out there on the EIA website and see if you can convince yourself that those numbers work. They don't. Now, again, I want to give us all the credit in the world. We have brought down our net imports by several million barrels from, you know, back in 2006, 2007, and that's a wonderful thing, both for us as a, you know, as proud Americans, and also for sending less money out of the country. But we are, the only way we're going to be oil independent is either when we can't compete with other countries to buy the oil that's left, or everybody just gets off of oil. This country is not going to be oil independent, and I don't care, you know, what somebody says. Show me the arithmetic, because I'll show you why it's let's just say it's extremely unlikely in my lifetime that we'll ever even approach it. Those are the facts.
And every U.S. president since the 60s and 70s, I can't remember if it was either Gerald Ford or Jimmy Carter or Richard Nixon, one of those guys started it. Every single president since.
They all said it.
Yes, all of them
and
said it.
And that's because they don't know the first thing about oil. They don't know I mean, Jimmy Carter actually knew quite a bit about nuclear. I mean, he was a nuclear engineer, but, you know, and I don't expect our political leaders to, you know, to know that much about oil, but they ought to check their facts. And of course, you know, what they say at a speech about how great we're going to be energy independent. Okay. You know, that's rhetoric, but the, you know, again, the truth is that, this country has not been energy independent, since after World War II, nor is it crucial that we should be. You know, I never hear anybody talk about, gee, wouldn't it be great if we were, you know, if we were coffee self-sufficient? I mean, who cares? You know, I mean, you like coffee? Where's the good coffee come from? It comes from Colombia. It comes from, you know, you name it. So you know, you buy it from them. I mean, trade is a good thing, right? I mean, that's my view. So
except countries have not gone to war. Except countries have not gone to war for coffee, Art. So
they've gone to war for almost every resource known to man. I agree with you. They haven't gone to war for coffee yet.
Yeah,
give us time.
Not yet.
Give us time.
Not yet, but maybe there'll be a coffee shortage or something, and then there will be. But
right.
Are we in an oil price now where the Saudis are worried? Because, you know, not too long ago, the Saudis were saying they're very comfortable with $60, $65 a barrel oil. They can make a profit there, and it's not too burdensome on a consumer. So do you think the Saudis are worried that this higher oil price, if it either stays at these levels or goes higher, will either accelerate more investment into renewable energies, maybe advanced biofuels, or more people converting to electric cars, or like in my opinion, a higher oil price also acts as a tax on the global economy, because then it takes away, you mentioned reducing profits. I think a higher oil price basically cuts consumer discretionary spending a lot for a lot of people who are not who are middle class or working people.
Well, of course it does. And so, are the Saudis worried? Well, beats me. I mean, they don't talk to me. So, everybody speculates about what the Saudis think.
They haven't invited you to go speak at a keynote conference over there, and you don't get to speak to any of the big shots?
No, not lately. I was over there about a year and a half ago for a drilling conference, but I didn't get a call from the head of Saudi Aramco or anything, and probably didn't even know I was in the country, and wouldn't have known who I was if he had. But no, I don't know what the Saudis think, and most of what people say the Saudis think is well, it's somewhere between speculative and just totally wrong. I mean, for instance, this whole idea that for the last 4 years that the Saudis have been in a price war with Shale. Where's the support for that argument? I mean, people take it for granted because it's been said so many times. But I mean, heck, if I were the Saudis, I really wouldn't care that much about Shale. I mean, I would look at the reserves. They've got really smart people, smarter than Art Berman, or at least with more resources. And they've done the same thing that I've done. And if I say the Permian Basin has 6 billion barrels, and again, it's not my opinion. I mean, that's publicly available data. You don't think the Saudis know that? I mean, 6 billion barrels. Even if you think Galwar is, on its last leg, it's still got 6 billion barrels in it, and it's a 70-year-old field. Compared to really big fields, 5 or 6 billion barrels is not that much. So, if, and this is speculative too, but if I were Saudi Arabia, I would be much more concerned about Canada's oil sands than I would be about the U.S.'s shale oil. Because the oil sands, that's a huge reserve base. It's got its problems, but that is on a scale that is equal to OPEC. And so I would be much more worried about that than I would be about, tens of thousands of relatively low productivity wells in a bunch of shale plays that don't last very long. Again, that's my opinion. But bottom line is, prove to me that there's a war going on between sheikhs and shale. I mean, I don't see it at all. And in fact, I mean, I have a degree in history before I became a geologist, and I listened to what the Saudi minister said back in 2014, and what I heard him say is, we will never make the mistake we did in 1982 through 1986, which was to cut, and not make a dent in global oil oversupply, except just lose a bunch of money. We're never making that mistake again. And when they decided in the early winter of 2014, not to defend the price of oil, I think more than anything else, they were saying, we've been here before, we tried this before, and we lost our shirts. We're not doing it again. Now, whether that was the right decision or the wrong decision, that's another story. But, I mean, when I've made a big mistake, particularly in business, and I've made plenty, until a lot of other things happen, that's going to guide me. And I think it guided them too. I mean, they're very pragmatic people, and they're extremely smart. I mean, and if you don't think they're smart, they can afford to employ the very smartest, the best and the brightest in the world. So, they're not acting out of lack of information. Again, I'm not saying that what they did was right. I have a hard time believing that there's a price war ever going on. Now, I'm not going to argue with people that think otherwise, but this is the kind of silliness, really, that distracts from the real issue. And I think you've brought up the real issue. The real issue is, will the price of oil or has the price of oil actually reached a level that will start limiting consumer buying of refined products? And if you look at the latest information out this week from the Department of Transportation, vehicle miles driven in the U.S. has flattened tremendously here in the last 6 to 8 months. Why is that? Well, there are many reasons, but I think the most obvious reason is the price of gasoline has been going up. And so, I filled my tank a couple of days ago, and for the first time in 4 years, it cost me $50. Hasn't cost me $50 for a long time. So I noticed, everybody notices. So, is it pain at the pump time yet? No. But if you notice, you're going to be more careful. So are they worried? I don't know if they're worried, but certainly they're smart. They're, they don't want, they would rather not get oil price to the point that it starts to hurt their demand and the other reasons you state. At the same time, they're trying to hold together a coalition of people, many of whom need money a lot more desperately than Saudi Arabia. And so, there's an incentive to, okay, well, let's just let this thing run for a while because, maybe that'll hold our weak coalition together if, Russia can get more cash to counter U.S. sanctions or whatever. So that's my view of that, Jason.
So do you think then if the oil price continues higher that more Americans are going to want to switch to electric cars because they're subsidized as of right now? People are getting a government subsidy. There's more charging stations like these supercharging stations that are going to be brought online. And a lot of these larger car companies in the next couple of years are going to be launching all different types of makes and models at different price points of electric vehicles.
Yeah, this Texas Energy Council meeting I was at a week ago, one of the other keynote speakers is my friend Scott Tinker, who's the state geologist of Texas. And he put up some really interesting slides and projections, and for a variety of reasons. I mean, Scott thinks that electric vehicles will never exceed 25% of the fleet, and that's just because they're electric doesn't mean that they don't consume an awful lot of resources, many of which are fossil fuel related, like the electricity to manufacture all those parts. But I mean, he cited an absolutely stunning number to many people, and that is that these wonderful Teslas that are out there, I mean, there's 7,500 batteries in one car. Where do you get all the lithium and, all of the rare earth metals and everything that goes into 7,500 batteries per car? I mean, so the notion, I mean, I'm all for renewable energy. Don't get me wrong. I'm in no way, wanting to promote oil and gas as opposed to renewables. But I mean, renewables they've got their own serious set of problems and obstacles. So I think the notion that that we're going to make this very quick transition to electric vehicles, if we do, it'll be the first time in human history that we've adopted some new and, let's face it, expensive technology that quickly. Now, having said that, I mean, the Federal Reserve Bank just put out a report on, the sort of the state of the U.S. economy year-end 2017, and what they said was that 2/3 of Americans cannot absorb a $400 emergency, whether it's medical or otherwise. So with that as calibration, if an electric vehicle costs $400 more, let's say, and it costs a lot more, even subsidized, than a gasoline-powered car, what likelihood do you think there is that suddenly anybody but rich people are going to go and buy electric cars? I think our expectations, our hopes for what might be as usual, have far outrun the reality of what's likely to happen. Again, I don't want to be pessimistic or skeptical. It's just, these things, these transitions, particularly in energy, they take a lot more time than most people want to admit.
Yeah, I've listened to Dr. Chris Martin talk about this, and he says on his research it takes about 4 decades. So to go from, wood burning to coal and steam engines, and, from that technology then to petroleum engines, to transition a large percentage of people doing it, it took about 4 decades.
And you could argue that, we've collapsed the speed of communication and lots of other things. So, let's be generous and say, what if it takes half that amount of time? That would be very positive, but it's still 20 years. It's a long time. So, no, I don't see anything that's happening in the short term, like the next year or two, as causing a flood of people to buy electric vehicles, except people that have enough cash, that are rich enough that they can afford to do it.
So
I hope I'm wrong, by the way. I hope I'm wrong, but that's what I think, since you asked.
Yeah, we'll have to see what happens. I think a lot of the electric car purchases are going to be mostly rich people's toys. So if you're very affluent and you have a a nice car like a Mercedes or Ferrari or Porsche in your garage, you're going to want an expensive electric car complement to that. And so a lot of these car companies, when the subsidy does come off, they're going to be offering at first the complement, the sports car or fancier SUV electric car version. And I think that's where the car companies are focusing on first. I don't think there's any profit margin for the cheaper electric cars. Elon Musk has this save the world type of vision that he's going to save the world with a cheap electric car that everyone can afford. I think it would overload the electrical grid. I don't think there's enough infrastructure for that right now. It's decades away. So in terms of the supply-demand fundamentals for oil, would you say that there's any major changes since we spoke about a year ago? Or do you think it's pretty much the same, and that the oil price just had a pretty strong rally, maybe because of the massive amount of speculative long futures contracts in oil? Why do you think there was a big rally then in the last year with the oil price, and also if there's an update then on supply-demand fundamentals in your opinion?
Well, the main reason is the OPEC production cuts. I mean, just plain and simple. I mean, if you take, last time I calculated it, and I can't remember the exact number, but it's something like 800 million barrels have been taken off the market as a result of the OPEC production cuts. I mean, that's a huge amount of oil, and I did the complementary calculation as to, well, in the same amount of time, how much tight oil has been added to the market, and it's a much smaller number. It's I can't remember the exact number, but it's a third. Okay, so the main reason that we're moving toward, or we are at a balanced, if such a thing exists, supply-demand market is because OPEC plus Russia and a couple of other countries, Mexico, have taken a lot of oil off the market. That's the simple reason. Now, the speculative piece of this, people often decry that as being foul or something. But let's face it, the price of oil is a speculative number. We're constantly involved in price discovery, and that discovery occurs by a combination of companies, hedging their physical bets because they produce oil, and a lot of people that wouldn't know what to do with the barrel of oil if they had to take possession of it, buying contracts and then selling contracts. So I know a lot of oil traders, and I think they're honorable people doing important work. Having said that, the long positions that have accumulated, I think, have accumulated for a very good reason. And I just gave you one of them earlier in the conversation. If you if you realize that instead of having an infinite amount of oil supply, the tight oil plays, 2 of the 3 of them are, in some state of permanent decline probably, and the one that you're, putting all your bets on is going to peak and at the very least can't deliver its potential for a couple of years. Well, what does that say? That says that, betting long on the price of oil is probably a pretty darn sound bet. Factor into that the ongoing chaos of war and civil unrest in the world, and the fact that there's always a country, whether it's a country in chaos like Venezuela or a very orderly country like Canada that unfortunately has a forest fire up in their oil sand area that shuts them down for a couple of weeks, or has a problem with the pipeline that carries their oil to the United States and had to operate at 80% for about 2 months. There's always stuff that just goes wrong. But more important perhaps than, or as important at least, as either of those is this, no-brainer kind of issue of the amount of underinvestment that's occurred since the oil price collapse in both exploration and production. Now, the same Goldman article that I mentioned a little while ago, they reckon that there's about a 6 million barrel a day gap that we're already in as a result of that underinvestment. That's 6 million barrels a day. That's huge. So we deplete about 4 million barrels a day, just the ordinary decline of existing, the depletion of reserves. So you don't have to be all that savvy, although I think they are if you're a hedge fund or a speculator, to realize that a long bet on oil is probably a really sound bet. And that's the fundamental reason that we see that, that big net long position. Now it's come down a bit in recent, weeks or months. I mean, those net longs peaked sometime in late January, and they, have kind of gone up and down. But even so, long managed money, futures and options still outnumber shorts by 12-1 as of last week. So we've come down from 15-1 to 12-1. And I don't know, the Kentucky Derby and all these other things. Those are low paying odds, aren't they? 12-1.
Yeah.
That says you're not going to get very much back if your horse wins, are you?
Yeah, and the contrarian in me is worried that there's too many people that are long oil right now. That if you miss this rally from last year, because the oil price was at around 45 around a year ago, and it's had a big rally. So congratulations to the people who bought a lot of oil positions back then. But if you're betting that oil is going to make the jump from the WTI price around $71 a barrel to $100 a barrel without potentially crashing the economy, then, it's a lot more dangerous proposition, I would say, because at some point, I think if the oil price does continue to rise, there's going to be more supply coming online, and or it's going to act as a tax on the global economy, and we could get back into a situation where the global economy is fragile as is. Rising interest rates, higher oil price, stronger dollar. The other thing I wanted to ask you about is, since you've been following the oil market for so long, normally doesn't the oil price rise when the dollar is weak? So the dollar has been having a rally lately and the oil price has still been strong. Are you surprised by that, or has that correlation been true in the past too?
It's always been a fairly weak correlation. It's been, it's true when it works, and like the broken clock, the people that love the fact that it works when it works keep claiming it works when it doesn't. And if they keep claiming it long enough, it's 12 o'clock twice a day. So my view of it, again, back to, anybody can check this. Make a graph of the strength of the U.S. dollar versus the price of oil. Take it back to 2000, if you like, and look at the correlation. And what you see is that, there are times when the correlation is very good, and there are times when it stinks. And the truth is that at least since the middle of last year, it stinks. Okay, there are some very brief periods where it seems to correlate kind of poorly, but it does kind of correlate. And then there are just as many times when it's doing exactly what it does now. In other words, they're moving in parallel. So, and of course, if you look at the magnitude, just compare the magnitude of the oil price increase with the interest rate or the trade weighted value of the dollar, the index or whatever, they're completely disproportionate. So to me, it's a reductionist, kind of simple-minded way of simplifying something that's hugely complex. The price of oil is never the result of one or five factors. It's just as soon as you think you got your hands around which 7 to 10 there are, you realize there was one that all of a sudden emerged that didn't used to be. So I mean, that's the reason guys like me stay in business, because it's a hugely complicated game. So simple answer to your question is, it works when it works. It didn't work now. So no, I'm not surprised at all.
Yeah, and I think the other reason to add in for a higher oil price that I forgot to mention a couple minutes ago was the Iran geopolitical. Eric Townsend mentioned that. So, the Iran deal not going through, there's a possibility then. I'm not sure how much oil that Iran sends to maybe Europe, that Iran can maybe punish Europe for not getting the U.S. in check with the nuclear deal. So I think maybe
a lot of that's been priced into the current price. I mean, first of all, let me just be clear. I think the price of both WTI and Brent are both too high right now. Not hugely too high. I think WTI is probably $3 overpriced. I think Brent is, maybe a little bit more, maybe, $4, possibly even $5 overpriced. So I think it's very probable an oil lost, $1 or $2, $1 or more today on a bad storage report the day before. But I would not be at all surprised. In fact, I expect that WTI is going to dip back down, somewhere into the upper 80s. Now, compared to where we were not so long ago, that's not real bad, but it's overpriced today. And and will it be a steady climb towards, name your number, 80 or whatever? No, it's going to have its ups and downs. The global economy, geopolitical factors, supply-demand issues. I mean, you name it. But so I don't see $100 oil unless there's a hot war in the Middle East. I think the Iran situation, the market, I agree with Eric, it's a factor. But, the market has had lots of time to digest that probability. And until there's, there are more signs of tension, I think that's priced in. And then, okay, so, we got a new wrinkle on North Korea today. That'll undoubtedly send things a little higher, and, maybe it'll stabilize, go back down. Maybe it won't. But, I don't really think that I think the real issue at the core of all this, believe it or not, is this whole fundamental issue of the tightness of supply. And we're seeing a clash of two paradigms right now. The ruling paradigm of lower for longer is now starting to be challenged by a lot of knowledgeable and competent people. And where's that going to go? Beats me, but it seems that that's really what we're looking at right now. And that if the emerging paradigm of maybe not lower for longer, I don't know, whatever you want to call it, if that gains more traction, which it seems to have done, then we're in new territory again, and we don't quite know the rules every time we go through one of these changes, these transitions. So I think we're in a place where prices, they're going to fluctuate, and it's going to go down a little bit, and people are going to say, see, it's going back to $40. I promise you somebody's going to say that, or $30, and it's going to go up. Oh, it's going to be $300. All of those extremes are wrong. I look at fundamentals. I also appreciate that sentiment and, emotion has a lot to do with it. But like I said, I think it's overpriced right now by a little. I think it'll correct. And then who knows what's next. But I don't see us going back to 30 unless the economy collapses. And I don't see it going to 100, certainly in the next year or so, unless there's an extraordinary event, a war, that would bring it there. So that's where I am on that, Jason.
I actually made a short video at the end of January talking about how the global economy needs a Goldilocks oil price. That's where the oil price is not too low so the producers can make a profit, and it's not too high so the consumers can afford it. So somewhere it can fluctuate in between those two extremes, and it has to stay there, or otherwise the fragile global economy, it's going to hurt either the producers or the consumers too much. But what worries me the most, Art, about the oil market, and this is the long term, and I don't think that shale oil will fix this, is the hundreds of billions of dollars in capex cuts for all the other oil production that's non-shale related. So I don't think shale oil is going to solve this. Temporarily it's made things look okay for supply in the short term, but long term there's major issues that worry me with all those capex cuts of hundreds of billions of dollars from the national oil companies, Deepwater, and so many other oil production in the last 7 years or so.
And I don't know if it's the right number, but it's a good enough number as a rule of thumb. If Goldman's right, if we're 6 million barrels a day in the hole right now, just every time that somebody tells you that this whole thing is a bubble and it's going to collapse, just think of what it's going to take, not what it could take, what it will take to dig out of a 6 million barrel a day deficit. That's a huge and epic level challenge, I promise you.
Yes, and that assumes that China doesn't, the demand for cars and oil in China doesn't explode. So I think there's pretty modest demand assumptions in those countries. So if there's a lot more cars sold in those countries, if the amount of cars sold explodes, and the amount of cars driven here in the United States and other developed economies doesn't decrease, there's going to be the demand is going to outstrip supply at some point. So in closing up here, Art, for our listeners out there, obviously this is an investors podcast. So where would you research? Do you think there's good investment opportunities in the oil market now, or are you worried, like you said, because the oil price is a couple dollars too high? Do you think then that people should wait to maybe look for investment opportunities in oil, or do you think there's good opportunities for our listeners to research right now?
I think there are a handful of good opportunities. I'm not personally heavily invested in oil companies. In fact, I hold only 2 at the moment. But I can quickly look at any of the graphs I put out there, just the capex versus cash flow, debt versus cash flow. Those are all publicly available on my website and Twitter. I put it out there. I think it's pretty easy to pick out half a dozen companies in the U.S. and Canada that are well managed, well positioned, currently have positive cash flow, and aren't burdened with debt. And some of those are big market cap companies. Even companies that I'm not always all that positive toward for other reasons. Companies like Pioneer and Continental, those are, I'm not always with the ethics behind what they tell consumers or investors, but bottom line, those are pretty good companies. Some of the more specialized shale producing companies, you look at a Diamondback or a Concho, despite, maybe Concho blew themselves out in their latest acquisition, but, to date, those are pretty darn good performing companies with awfully good position. I could mention a lot more, but I think your audience wants to hear a few names. I don't own any of those stocks, so and I'm not recommending anybody buy them, but I'm just saying those. Look at the graphs. You can pick them out for yourself. But for me, I look for companies that have a portfolio. They're not just in one play. Again, think of a company, let's just say like Oxy, for instance. They're huge in the Permian Basin, but they're an international company. A company like Murphy, they're big in the Eagle Ford and a couple of other unconventionals, but they got got a diversified position. Those, they don't, and sometimes these companies don't have, spectacular multiples, but they're solid. Okay, so the price of stock price has gone way down over the last 8 or so months. So maybe it's come back up a little bit, but I think there's opportunities out there. But again, I'm not a financial advisor, but just as somebody that looks at these companies. I'd look at those and use your own criteria to decide if I'm just guiding people towards. And what I look for, CapEx cash flow, easy numbers to get at, debt cash flow, cash from operations in both cases. If they pass that high level test, then dig in. And I think once you've put that filter on it, you'll find a bunch that you're going to toss in the heap, but you're probably going to find a few that you might want to invest in.
Yeah, thanks for sharing your opinion. Obviously, our listeners should do their own research and do their own due diligence. And the one piece of advice I would say with an oil company is watch out for oil companies with too much debt. So
Absolutely.
if they have too much debt, because even big companies like ExxonMobil, they've done too many share buybacks with debt at higher and higher stock prices. They've been doing this for years. I call it financial engineering. Royal Dutch Shell was involved in some form of this as well.
Sure.
Jim Chanos, who's a short seller, well-respected short seller on Wall Street, will short that. So be careful. Look for the companies, if you know how to read financial statements, look for companies that have too much debt, where they're paying way too much interest payments on the debt. So
you got it.
Well, Art, I really enjoyed our conversation today about the oil market. You're such a wealth of information about the oil market. If our listeners want to follow more of your work on your website, how do they do so?
artberman.com, and you can see what I'm thinking daily on Twitter. That's AEBerman12, at AEBerman12. And, I give it away for free. I don't have any paywalls on my website. You can find whatever I think. You can find all kinds of graphs. You can find those CapEx cash flows, debt cash flow, in multiple different places between Twitter and my website. So, if you're interested, check it out. If not, follow your bliss.
Okay, great. Well, thanks again for your time. And I think the oil market's so fun to watch. I mean, like you said, there's just so many factors and variables that it's just so interesting. It keeps going up and down. It's a boom bust. It's one of the most exciting markets to watch and pay attention to.
I totally agree. Always a pleasure to talk to you, Jason. You take care.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.